Good morning, folks. Brian Hale with Mortgage Advisory Partners. It's Monday, March 18th, coming to you from my office in Newport Beach, California. Included in this post, as it is every week, is a link to our weekly newsletter, as well as a link to subscribe to the newsletter. As I've mentioned over the last couple of weeks, we continue to see an immense surge in subscriptions. We had over 200 last week. We're well into the thousands, and I encourage everybody to subscribe, primarily because it's free, but really, to be honest, I think it's well written, particularly for originators, branch managers, area managers, regional managers, to give you both a sense of what's going on in the market, to explain some of the background, to give you a sense of the things that are driving the market, as well as what's coming up this week in terms of data or information or releases that could drive your market one direction or another. If you subscribe, you get the newsletter on Friday as opposed to on Monday here as we publish it publicly. And again, I've always been really transparent about this. We don't write the newsletter, we publish it. I did a fair amount of research to find what I thought was the right letter for folks out in the field dealing with clients and customers every day. And hopefully you'll find value in the newsletter. This week's newsletter uses a great metaphor. We all probably remember this as a kid when we were in the car on a long ride with our parents, and we kept asking our parents, are we there yet? Are we there yet? Are we there yet? And it really is spun around the idea that in November and December, obviously we had a dramatic drop in interest rates, driven by materially lower inflation and some economic data that suggested that the economy had cooled materially. Unfortunately, since that time, we've had exactly the reversal of all of the gains that we got in November and December. We're essentially back almost flat to where we were before those markets began to improve. Last week, we had CPI and PPI came out. Normally, it's CPI, the Consumer Price Index, that tends to move the market more. But actually, last week, the Producer Price Index, the index that measures inflation at the wholesale level, continued to show a lack of improvement and actually worsened against the expectations. And so we saw a pretty dramatic impact in the marketplace on Friday. So the data came out on Thursday. This week, we have new home sales, we have existing home sales, but more importantly, on Wednesday, we get the Fed interest rate decision. We're going to get the Fed economic outlook, and we're going to get the chairman of the Fed, Powell, will be doing his press conference. Those have as much of a chance to move the markets. And I've said over the last couple of weeks, and I don't say this to spook people in the process, but I think that there's a not zero chance, maybe as high as a 25% chance, where you could actually see the Fed make one more raise in interest rates in an attempt to finally bring the inflation rate back down to 2 or less, which has been their target all along. Clearly, the rapid descent of inflation last year into November and December has effectively stalled at just above 3%, 3.5%, 3.6% annualized inflation, which is still simply too high for the economy to sustain over a long period of time. That said, we continue to see people spend money, get jobs. There's immense job creation that's been going on, and the market has so far resisted the Fed's effort to cool inflation. So again, if you take a look at the newsletter, you'll see the data that's coming out, the dates, the expected levels, what they expect to hear from the Fed this year, this particular week. And again, unfortunately, this long drive, and that's what the newsletter uses as a metaphor for a long drive with your folks, this long drive to lower interest rates. You know, there was a promise of 6 rate cuts this year. Clearly, that's no longer in the cards. Clearly, there's no longer a rate cut in March. If anything, there could be a rate increase. And now the odds-on view is that the first rate cuts are likely to be July, and maybe somewhere between 2 and 3 rate cuts over the balance of the year, but that's by no means guaranteed. I continue to believe that 2024 is going to be a very difficult year in the mortgage and real estate space. And hopefully the second half of this year will be better, and it'll portend for a much better 2025. With that said, I encourage you to subscribe to our newsletter again. You need to watch this space over the next month. There's going to be some exciting announcements coming out, opportunities that we're going to present out into the marketplace. And I encourage you to pay attention to this space each and every Monday. And as we have more to say about the coming announcements, we'll certainly begin to talk about them more here as we go forward. So with that said, I wish everybody a great week and look forward to talking to you again next Monday.